Right now in Canada, first-time homebuyers are walking into the biggest financial decision of their life, relying on the advice from the one party that profits when they get it wrong, their bank. And it's costing them. We're talking tens of thousands of dollars over the life of a mortgage. Not for a market crash, not for a rate spike, but from 5 specific traps that nobody warns you about until you've already signed and it's too late. If you're planning on buying your first home in Canada in the next 12 months, the math you're about to see is the difference between owning a home that builds you real wealth and owning one that quietly drains it. First off, here's the rules of the video. We're not doing rate predictions. We're not doing fear-mongering. I'm not telling you to wait or to rush. It's just math, cash flow, and the 5 specific traps your bank rep would prefer you didn't know about. Trap 1 is the pre-approval lie. Trap 2 is the ratio you've never heard of that kills 1 in 4 deals. Trap 3 is the wrong account choice that could cost you upwards of $15,000. Trap 4, the down payment math that flips the script on what minimum actually means. And Trap 5, the fixed versus variable decision most people make with their emotions instead of their numbers. Now, you might be thinking, Myles, this all sounds great in theory, but does it actually matter? Let me show you the exact math. On a $500,000 mortgage in Canada today, getting any one of these 5 things wrong can cost you between $8,000 upwards of $40,000 over your first 5-year term. Get 2 wrong, and you could be sitting at a 6-figure mistake before you've even refinanced once. Hope isn't a mortgage strategy. Talking numbers and understanding the details is. So let's get into the data. Trap number 1, the pre-approval lie. Most first-time homebuyers or buyers in general think that getting a mortgage pre-approval in Canada means the bank has approved them to purchase a home. It doesn't. A pre-approval is a rate hold. That's it. The bank holds the rate for 90 to 120 days. They have not underwritten the deal. They have not verified your income, and they have not looked at things through their final lens. They've not even approved the property yet. How could they? You haven't bought one. Here's where the buyers get burned in these situations. They write an offer thinking that they're locked in, and then on closing day, the bank comes back and says, well, actually, your debt servicing ratios came in a bit too tight, or the appraisal came in $30,000 under the purchase price, and now you're scrambling. You're putting more cash down than you planned. You're losing your deposit. You're stuck with a second-tier lender at higher interest rates and potentially with lender fees. The fix is simple, but almost nobody does it. Get a real underwritten pre-approval, not a rate hold. Ask the question directly, is this fully underwritten or is this just a rate hold? If they pause, you've got your answer. And that's why at our office, we don't even quote rates or send you shopping until we've fully dived into the application, looking at job letters, pay stubs, T4s, NOAs, whatever we need to confidently say that you can purchase for what we're saying you can purchase for. At that point, once you're fully underwritten, that's when we send you out shopping for a house, and that's when we quote those interest rates for you. That way we don't waste any time for you, your realtor, and we don't promise you something that we can't deliver. Trap number 2 is the GDS and TDS math that you were never really shown. This is where I'm going to give you something that most people don't actually see or talk about until it's too late, because it's more on the bank side of things than the consumer. The bank uses 2 ratios to decide if you qualify. Your GDS, or gross debt servicing ratio, and your TDS, or total debt servicing ratio. GDS is your housing costs compared against your income. TDS is that plus every other debt. Your car loan, your line of credit, your minimum credit card payment, your student loans. Most lenders cap GDS at 39% and TDS at 44%. Here's the trap though. The first-time buyer goes to the bank in February, gets a pre-approval based on their numbers that day. Then in April, they finance a $25,000 car. That $450 a month payment just blew up their TDS. The property they thought they were approved for, well, they don't qualify anymore. So if you are looking at buying a house, if you are looking at making changes in your life, run your TDS before you make any major purchases between pre-approval and possession day. Math doesn't care about what you want to do with your money or that you wanted that 0 down offer from the car dealership. It cares about math. That's about it. Trap number 3 is the RRSP, or home buyer plan, instead of the first home savings account. And to be honest, this one makes me genuinely upset because the bank knows better and they're still pushing the wrong product. For decades, the home buyer plan let you pull money from your RRSP for down payment. You had to pay it back over a course of 15 years, but if you skip a payment, it gets added to your taxable income that year. In 2023, the federal government launched the FHSA Canada, or the First Home Savings Account. It's a hybrid of an RRSP and TFSA. Contributions are tax deductible like an RRSP. Withdrawals for your first home are completely tax-free like a TFSA. And this is the part nobody talks about. You don't have to pay it back. Ever. If you have $16,000 of first home savings account room and you're still being told to use the RRSP, your bank rep is either uninformed or hoping you don't notice, because chances are the RRSP they're offering you is through their institution. The trap is being talked out of using it. Trap number 4, down payment myths that are completely backwards, even though they don't sound like it. This is where I'm going to challenge what you might think you know. Everyone tells you to put as much down as possible, 20% if you can. Avoid CMHC insurance. Be mortgage-free faster. That advice is wrong for most first-time homebuyers in Canada today. In fact, it could be wrong if you're buying your second house. Here's why. CMHC premiums on a 5% down payment is 4% of your mortgage. On 10%, it drops down to 3.1%, and on 15%, it's down to 2.8%. That premium gets rolled into your mortgage. You don't pay it out of pocket. On a $500,000 purchase, the difference between 5% down and 20% down isn't the insurance cost, it's $75,000 of cash that you no longer have access to. Here's an example of this. If you carry $20,000 in high interest credit card debt, let's say at 19.99%, and you put 20% down to avoid CMHC, you've just locked in that high interest debt at 19.99% while saving 1% on your mortgage insurance. The math is brutal. Sometimes putting less down and crushing consumer debt is the right move. Not always, but more often than the banker's willing to admit. And if you take an insured mortgage, there's the added benefit of lower interest rates. Let's say you put 19% down, you're officially a fully insured mortgage. You're going to get lower interest rates from the bank. And that's where we run those numbers to say, hey, does the premium that you're being charged make sense to pay based on the interest saved over the mortgage because of that lower rate? That's just math that we run for people because it makes sense. I had a client that opted to put 19% down instead of 20%, and it ended up saving them thousands of dollars in interest because the interest rate difference was that aggressive. Trap number 5, and the final one, is trying to pick fixed versus variable, but basing it on emotion. Fixed versus variable mortgages in Canada is one of the most Googled mortgage questions in the country. And almost everyone answers it backwards. They look at today's rates. Variable is cheaper, so they take variable. Or they're scared, so they take fixed. Neither of those decisions were based on math or data. It's a complete reaction to what you're seeing, and it's a snap reaction too. Here's the actual question. If a variable rate goes up by 0.5%, can you absorb that without changing your lifestyle? If it goes up by 1%, same question. If the answer is, I'd be stressed out, but I'd be okay, then variable is likely a good option for you. If the answer is, we'd have to cancel daycare and sell a car, probably don't go variable. Try for a fixed, even if the variable is cheaper today. When you're looking at variables, never take it based on the fact that it's the lowest possible interest rate. Take it based on a strategic move that aligns with your goals and what your comfort levels are. For example, if you're going to take a variable rate and let's say it's 0.75% lower than the fixed, it might make sense to opt to increase your payment to match that fixed rate. For one, if rates go up, you're protected. For two, you're paying your mortgage down significantly faster, lowering your balance and your cost of interest. See, variables aren't necessarily about getting the lowest rate. It's about building the best strategy for you. These 5 traps are not the only ones out there. They're just the 5 that can cost a first-time homebuyer in Canada the most money in 2026. If you want help mapping these out for your specific situation, there's a link down in the description below where you can book a call with me and my team. There's no pressure. It's just clarity. We'll run your actual numbers, not generic ones, and try and find the solution that's best for you. And if you're not a first-time homebuyer, if you're sitting at a renewal or know someone sitting at a renewal in the next 12 months, wondering if you should go fixed or variable for round 2, I made an entire video on the math of that decision. It's right here on the screen, same approach, just math, no predictions, no hype. My name's Myles Nowik, owner of the Nowik Mortgage Team, powered by Indy Mortgage. If you got value out of this video, maybe hit that like and subscribe button so more people like you can see it, and we'll catch you on the next one.